welcome to this week's MFB News. I hope everybody is very well, not too disappointed about the football result. And for those of you like myself who are knee deep in summer holidays, I hope it's going well, hang on in there. And for those of you who are about to join us at the end of this week, good luck. Now, in terms of what we got for you today, we're going to be doing our usual roundup on what's been happening with swap rates. We're going to talk about lender pricing changes, lender criteria changes. Now, in terms of the kind of more detailed pieces, this week we're going to be chatting about the latest news on GDP, inflation, and how that then echoes through to what's going to be happening with base rate. We're going to touch on the King's Speech, which is happening today. So it's currently 7:05 in the morning. The King's Speech is kind of happening very, very soon. So we're going to talk about what's going on in there and how this can impact you as landlords. And then finally, we're going to be chatting about something called co-living, which is kind of a buzzword, which I've seen coming out more and more in the landlord community. So I think it's just worth us having a quick look at what co-living is, who's actually taking part in it, and why it might be of interest to you. Okay, so first up, swap rates, and things are going in the right direction, albeit very, very slowly. So when we spoke last week, 5-year swaps were just under 3.9%, I think, from memory. This week, 3.831. So they've come down ever so slightly. And as we said last week, you know, changes going forwards now, unless something really kind of crazy happens, it's going to be very much a slow kind of evolution rather than a revolution. So 3.831 as of 10:30, so 10:45 last night. To give you some comparison, 1 month ago, 3.866. They did kind of go up again with the election and then down. 1 year ago, 4.977, so we're at 1.2% broadly speaking, in a better place we were 1 year ago. And it's very similar again with 2-year swaps. So 2-year swaps as of last night were at 4.333, 1 month ago 4.451, and 1 year ago 5.787. So the difference year on year is quite notable on the 2-year swaps compared to, or a greater difference than there is on the 5-year swaps. Does this mean that the markets are pricing in a more imminent base rate reduction? It certainly feels like it. Okay, so in terms of how this is then filtering down into lender pricing changes, so we've seen over the last couple of weeks as swap rates have been fairly kind of steady and, you know, very, very slowly moving downwards, a wave of lenders reducing pricing, and it's been more of the same in the last week. Again, there aren't really sort of huge rate slashing going on. I wouldn't expect that given where the lender's pricing model sits, i.e. swap rates. So, but what we have seen is lots and lots of lenders, essentially the lenders who hadn't repriced in the last couple of weeks, are kind of joining the party. So in terms of, first of all, your clearing banks, your high street institutions, your more vanilla, as we like to call them, excuse me, lenders, we've seen NatWest make reductions of up to 0.15, BM of up to 0.15, Virgin up to 0.12, Santander of up to 0.1%, Coventry have also made reductions. So it's really good to see the clearing banks joining the party. In terms of specialist lenders, we've seen West1 make reductions of up to 0.17, Landbay have made reductions of up to 0.1, Aldermore have released a bunch of new rates. So their rates are now starting from 4.89% for single property applications and 4.79 for multi-property applications. So you guys remember from previous videos, if you're a habitual watcher, Aldermore are one of the very few lenders who can do an arrangement where it is one single mortgage secured against multiple properties. They offer a slightly more favourable pricing where it's a multi-property application than if it's a single application. Vida Home Loans, these guys win the prize, I think, this week for largest rate reductions of up to 0.35% and Foundation of up to 0.3%. So, you know, broadly speaking, all we're seeing here is very, very tiny pricing adjustments. So nothing that's going to kind of change your life, but a step in the right direction. And as swap rates, fingers crossed, continue to come down very, very gently, we should continue to see lender pricing models change. I think also it's just worth sort of noting the time of year now. So at the moment we're going into summer holiday season, so lenders will be kind of thinking about what their kind of priorities are here. So on one hand, they want to lend you money. There's no escaping the fact lenders want to lend you money. If they don't lend you money, they don't make any money. So they need to do this. It's all part of the business model. And they're going to want to pass on pricing changes to their borrowers because lenders need to make a fixed margin above their cost of funds. It's not like they're kind of, you know, taking advantage when the costs come down. Lenders are passing on the reduction to you guys, as you can see here from the rates we've just talked about. But also what lenders are going to be doing is thinking about business volumes, and no one's going to want to go too crazy in terms of their rates and get a massive wave of business, when the reality is they're probably going to be slightly down on headcount in terms of staffing because it's holiday season. So I do think that actually lenders are going to be kind of very mindful of service levels, not wanting to be the kind of standout cheapest lender, getting awash with business, getting a massive flood of business through, then are able to kind of turn things around in a kind of acceptable time frame. So I think at the moment and for the rest of the summer, we are going to see a continuation of very slight pricing adjustments, obviously assuming that swap rates do continue on their downward trajectory. But what we're not going to see is anyone doing anything crazy until probably September, when lenders are going to be kind of back for business in full and able to handle higher business volumes. Now, in terms of criteria changes this week, we've seen a couple of things actually which are quite interesting. So two very different types of criteria changes. So first of all, Vida Home Loans have changed their criteria. So what they're saying now is that all defaults and CCJs will be ignored if they're under £250. Now, this brings into kind of whole sort of discussion around adverse credit or credit blips, which we can probably cover off in another video because it's a whole kind of piece of content by itself. But actually what we do often come across here at MFB is we will have a landlord who has got an absolutely impeccable credit file. However, then there might be some kind of dispute or some kind of lack of miscommunication with, for example, a water supplier, where then the landlord ends up with a CCJ for maybe £50. And actually this can be the difference between being able to get a mortgage and not being able to get a mortgage. So it's very, very good to see that Vida Home Loans are now ignoring things under a £250 threshold, which would cover all those kind of accidental misdemeanours, I suppose. Now, there are other lenders who can do this, don't worry. It's not just Vida, but interesting to see them kind of take a very pragmatic approach when it comes to lending to landlords. Now, the other thing that's happened in the last week is that Shawbrook have finally introduced a product transfer offering. Now, the reason this is so important is that people that then tend to go to lenders like Shawbrook, Hampshire Trust, Interbay, those kinds of lenders, these people tend to take across to these lenders semi-commercial properties, so residential and commercial parts on the same title. They might take across a really, really large portfolio. So, you know, one single loan, again, kind of echoing back to what Alden were able to do, Shawbrook can do the same. So one single loan secured against multiple properties. And it could be that the security is, for example, a really large HMO or a very, very large block of flats. So you tend to find that with people who have gone to the likes of Shawbrook, they're not particularly easy to refinance to lots of other lenders. So when their deal comes to an end, it's not like there is a whole abundance of choice of lenders to go to. And until now, Shawbrook haven't had a product transfer offering. So they've kind of been able to give you a new rate, but you essentially had to reapply for it. So the fact they've brought in a product transfer offering is really, really welcome. So if there's anybody watching this who is on the Shawbrook standard variable rate, or you're coming to the end of your product, Shawbrook will now be able to offer you a switching option. And having seen the process myself, the amount of information they ask for is really, really minimal. So that's going to be an absolute lifesaver for some borrowers. Okay, now we have the next MPC meeting on the 1st of August, so just a couple of weeks away now. And there is some real kind of rife speculation in terms of what the MPC are going to be doing with base rates. So the predictions were for a long time that rates would come down in August. And then kind of with various things that we've talked about in previous episodes, the likelihood of that dropped to sort of like 50-50. And there's two pieces of news that have kind of come out, which I think is just going to give the MPC an even bigger headache, essentially. So the first thing is that, as of this morning, actually, inflation data has come out and it's telling us that the inflation rate in June was just 2%. So actually, it stayed the same as it was in May. So 2% is the target level for the Bank of England at which to keep inflation, and it's staying at that level. So one could argue at this point that there is a cause for base rate to come down in August, essentially. However, last week we also got the news about GDP. So UK GDP grew by 0.4% month on month in May, and following no growth in April. And this is according to the latest statistics from the ONS. Now, services output grew by 0.3% in May and was the largest contributor to monthly GDP growth for the month. Production output recovered with 0.2% growth following a fall of 0.9% in April, while construction output grew by 1.9% compared with a fall of 1.1% in the previous month. GDP is estimated to have grown by 0.9% in the 3 months to May, compared with the previous quarter, driven by a growth of 1.1% in services output. The first quarter GDP growth has revised up to 0.7%, and annual GDP growth now stands at 1.4%, which is much higher than people thought it would be. So, as a result of the higher than expected economic growth, some economists now predict the Bank of England could hold off reducing the base rate until later on this year. So the report that I was reading on this says that the surprise growth figures for GDP, particularly considering its best growth over 3 months for more than 2 years, are creating a huge conundrum for the Bank of England. If the economy is beating inflation and tolerating much higher rates than it has done for over a decade, why cut your rates? Now, what we're going to be waiting to see essentially is what happens on the 1st of August. But essentially what we've read is that actually this has kind of thrown the capital markets into even more of a conundrum about where they think pricing is going to go. So inflation is kind of where it should be. That's in favour of a base rate cut, but GDP is higher than expected. That goes against it. So I think, as usual, we're just going to have to watch this space and see what happens on the 1st of August. Okay, so as I mentioned, it is Wednesday morning and today is King's Speech Day. And with the kind of arrival of a new government, it's going to be really interesting to see how that shakes out. Now, we don't have the full details of the King's speech. Actually, it's not protocol essentially for these to be published. The King will kind of announce what his government's going to do later on today. So we don't have the full details. However, from what we've seen that's been outlined so far, there has been no mention of the abolishment of Section 21 in there, although we do think it is going to still come into play and be part of the King's speech later. Now, one thing just worth noting is that actually the government, if they do decide to introduce Section 21 via the King's speech, it would require new legislation to ban it. However, because Labour have such a strong majority and because the Tories were also in favour of getting rid of Section 21, the reality is that if it is introduced, it would pass through very quickly. Now, in terms of other stuff that has been mentioned as being included in the King's speech, as you as landlords, I think there's a couple of things that just are really worth noting. And this comes under really the section house building and devolution. So the first thing under house building legislation, to address the housing crisis, there will be significant bills aimed at boosting house building. Taking Back Control Bill, this bill will develop powers over energy transport skills and planning to mayors and councils, including the reinstatement of cancelled bus routes and setting affordable fares. So I think in terms of really how this impacts you as property investors and landlords, realistically, for those of you who are looking to do some building works or kind of development, new rules for house building could be very much in your favour. In terms of things like reinstatement of cancelled bus routes, this is really just kind of thinking about infrastructure. So if you're thinking about investing in property, for example, this is the kind of stuff that really impacts desirability of a property for your tenants. So worth kind of watching this space. Now, in terms of the upcoming parliamentary schedule, the House of Lords is going to start debating on the speech on the 18th of July, initially focusing on energy, the environment and house building. So house building is going to be top of the list of things to be discussed. We've got a break for the 4-week recess at the end of July and they return at the start of September, which has been shortened, having a less week's holiday this time around to allow for the government to take more actions. So I think realistically after today, it's probably going to go relatively quiet and we're going to hear more about some of the changes that could be coming in September now. Every now and then we come across a new buzzword that's doing the rounds and something that kind of forms a trend for a while. So rent to rent was kind of one of the more recent examples of this. And more recently, I've seen the phrase co-living being used fairly frequently. So I've had a bit of research into it. So what is it? How many people are interested in it? Who's actually doing co-living letting? And is it something that you guys as property investors need to be aware of, either because it could start to kind of provide a type of housing that becomes popular and you might want to get involved in it, and equally it's going to provide a type of housing that you don't offer, which may be almost essentially a threat to your business. So this is why we're going to be covering off co-living today. So first of all, co-living, so what is it? Essentially, it's a hotel-like model. It has elements of a hotel and elements of kind of student accommodation, essentially. So each tenant is given their own private room, but the design is such that the majority of tenants' time is spent in communal areas. And this is kind of the key thing here. And this is what kind of differentiates this from kind of a typical HMO or multi-unit. So rooms are almost always en suite, and it's also common to have a simple kitchen facility within the room, such as a small cupboard space and a fridge. However, these are geared up to form a more social style of living. So as well as shared facilities, there'll be more social spaces. So this could include things like a games room, work zones, gyms, study areas. And one I was reading about, actually, they even included a cinema. Often with these arrangements, bills are all included in the rent, which gives the tenants kind of more surety in terms of costs. And the main people that seem to be investing in these at the moment are institutions. So institutions are investing in these on a larger scale. So think of essentially a block of flats with shared social facilities. So a bit like a MacArthur Stone for young people. So co-living is emerging as an alternative approach to delivering high quality rental accommodation in accessible locations. And this is according to the estate agent Knight Frank. So Knight Frank have gone on to say that in the last year, the UK saw nearly 2,500 new co-living beds completed and open to residents, reflecting a 65% increase on co-living delivery in 2022. It takes the total number of operational co-living homes in the UK to 7,540. A further 13,483 co-living units are currently under construction or have planning permission granted. So there's going to be essentially a almost tripling of the number of co-living spaces available. So according to Knight Frank's 2023 UK Living Sector Survey, so try saying that after a couple of glasses of wine, which captured the views of leading institutional investors who currently own more than £75 billion worth of co-living sector assets across the UK, 45% plan to have invested in co-living by 2028, and that's up 32% of respondents who had already invested. It suggests that existing investors view co-living as a means to capture a more varied tenant base and diversify their portfolio in the build to rent in terms of property and tenant type. Most of the co-living developments to date have been delivered in London. Some 74% of co-living development has been delivered in the capital, with 6,722 units under construction or with full planning permission granted, located outside of London, led by regional cities. So outside of London, we have Manchester, Liverpool, Sheffield and Birmingham leading the way, thanks to their large and growing population of young professionals, strong graduate retention rates and expanding employment markets, which make them viable locations for developers and investors. However, the pipeline confirms that co-living isn't just workable in major cities, with schemes coming forward in smaller markets such as Woking, Reading and Guildford, a trend Knight Frank expects will continue as the sector grows. In total, 33 local authorities in the UK have a co-living scheme either complete, under construction or with planning permission granted. So there you go. So co-living is really a growing kind of offering. And I was really kind of thinking about this in terms of how this could impact the landlord market. Now, as landlords who, you guys aren't going to be building large developments of flats, broadly speaking, you're not going to be building large developments of flats with a cinema and a gym in place. But I think what this really demonstrates is a kind of shift from people who live in shared accommodations, so either in HMOs or multi-units, where people live in a sort of fairly solitary way, to kind of a trend where people are actually looking to have places where they can be co-living with other people, but also have their own private spaces as well. So I think, for example, if I was a landlord now thinking about investing in an HMO, rather than just sort of thinking about having a living room / kitchen where people can kind of congregate together, I'd be thinking about how I could maybe curate a space which was beyond that to kind of encourage more social living. This seems to be kind of the trend. So whether that would be kind of like a work zone, that would be a fairly easy one to implement, wouldn't it? Or some kind of social space, maybe a games room, but really just a place where people can kind of legitimately and in a relaxed fashion come together outside of their own private area of the house and spend time together. And I think maybe that's kind of the way the trend is starting to go. But yes, I found that really interesting and really just worth kind of sharing with you. Again, you often hear these terms bandied around and we don't really know what they mean. So if you do hear about co-living going forwards, you're now experts on it. And that's everything for us this week. As always, thank you so much for watching. I do hope you found that helpful. And if you have anything you'd like us to cover off next week or in weeks to come, please do just ask either in the comments below, or you can just email in inquiry@mfbrokers.co.uk. And on the subject of kind of inquiries, if you want to give us a call about anything, we'd love to have a chat with you. 0345 345 6788. And as always, our website is open 24 hours, 7 days a week at mfbrokers.co.uk. Do enjoy the sunshine. It's looking to be rather lovely over the next few days, so I think you'll need to capitalise on that, because you just can't quite figure out when it's going to be absolutely chucking it down next. And I will see you again same time next week.